Hey team, Ray Campbell, Fairway Independent Mortgage. It is actually Tuesday, October 22nd, 2024. A lot of things going on in the real estate market as far as interest rates go, and going to give you the market update here in a minute. But before we get into that, wanted to send a special invitation to everybody, letting you know that there is a high profile networking event called Elevate at Tower Club in Dallas. It is going to be on Veterans Day, November 11th. If you're interested in going, let me know. I can get you the page to be able to get some tickets to it. But it's an event that you want to be at. It's all black attire. It's going to be a next level networking business expo type situation where you can come and meet and network and get to know some of the up and coming and established businesses in and around Dallas. So you want to be a part of that. But the biggest part that I wanted to get out there too is that AWI, American Warrior Initiative, is Fairway's nonprofit, is going to be the beneficiary of the event as well. So we're going to be looking to raise funds for that. Where if you're familiar with us at all, and then you have an idea, it's Red Friday every Friday. We wear red shirts, if I could say that correctly. And to support the military, we do everything we can in AWI. We raise money and train and raise service dogs and then award those to disabled veterans who need them. So it's a very good cause. We'll hope to see a lot of you out there. So let's get into your market update. All right, guys. So it is the 22nd of October, and since October 2nd, it has really been nothing but bad news as far as interest rates go. So we started out the month where, we were getting really good on interest rates. We were starting to talk about a bunch of refinances for people. We were seeing interest rates drop, significantly. At the beginning, the national average, of course, started 6.132% for conventional mortgages. We are now up to about 6.556. As of yesterday, and FHA, of course, just below 6%, 5.922%, and now we're just up a little bit, not as much there, 6.175%. So these are averages, right? They don't take into account how many points people are paying, discount points, things like that. So everybody's situation is going to be a little bit different, but the overall scenario is essentially interest rates are up. And as we've discussed, as interest rates come down, that's a good thing, but they don't just come down, right? They're not going to just come down. There's going to be bumps in the road where, things are going to move the opposite direction a little bit. They're going to come back up a little, and then they're going to come back down. So we don't typically see a move, let's say, of 0.5%. However, it's not uncommon either that, that can happen. So it's one of those situations we just kind of deal with it, as it comes, and, adjust accordingly. Clients, have their concerns about interest rates. There's lots of ways to structure mortgages to get the interest rates down and not have to have such a high payment. But, make sure they're talking to their lender about how they can, structure their mortgage, and don't just settle for a 30-year fixed mortgage, with whatever structure. There's 12 different ways to structure the same 3% down conventional loan by changing the rate structure and mortgage insurance, so make sure that they're having those conversations about their options. Now, what's causing this, there's a whole bunch of different things causing it that we're seeing, but essentially it all comes down to inflation, as we always say. But there are still some concerns that inflation is not actually under control and may creep back up again as the Fed starts to do their easing, where they're cutting interest rates, which is supposed to spur the economy. And there's a few Fed members who've come out and said recently, and this is where some of the big moves have come from, that they're concerned that the cuts might need to be paused because they're worried about the inflation coming back and that being a problem for them. So they're not entirely convinced, and it turns out that the bond markets just kind of needed something to go with and said, yeah, I kind of agree with you. So we're going to go ahead and start to sell off. We're going to pull back on some of these positions. Some of it could be profit taking, of course, because we had a good ride up for a little while. And then some of it could also be inflation concerns. So along with the inflation concerns, we also have China. So I mentioned it, a week or two ago in my last update to y'all, that there was a concern about China and what they were doing to stimulate their economy, and the government announced additional stimulus the other day that is basically adding additional concerns to the inflation. Now, the question, of course, everybody has is, well, why did interest rates go up? And then we get into a whole conversation of, well, these are the things that happened. And right now it has to do with China. On top of what's happening here, you add in the stuff that's going on with China, where if they're stimulating the economy in China, that's of course inflationary. And we are all tied together, where inflation in one place affects the other. The goods that are coming from China would be more expensive, so then you have goods here that are more expensive. There's a move to treasuries as well, and this stimulus is printing money, so it's got to be paid for somehow. So then it's, municipal bonds and treasuries and all of those things that the government needs money. And how do they come up with it? Well, that's bonds and treasuries. So when these things are happening around the world, they do affect us in the United States, and there could be a move to treasury yields having to be higher, which we are seeing because of the move, again, partially from what is happening here and the concerns here, but also adding to the flames is, of course, China and what they're doing for their economy and their additional stimulus that the government announced to help boost their economy and their stock market. Now, the next thing that we have, of course, is spending in the United States. We all know that we are a nation of debt, that everything that we look to do is surrounded by debt in some sort of another, form or fashion, where I kind of make light of it. And I tell people when they ask me what I do is I put people in the most debt of their life. And that is generally a accurate statement, where a mortgage is usually the largest debt that somebody takes on. We obviously, finance the largest asset of their life with it, but it's still debt, right? So the United States spends money like crazy, and we spend a lot of money in a lot of different areas, and we're not going to get into the politics of any of that, but that spending is a concern. And when we have additional spending, of course, the government does not have any money. There's no easier way to say it. It's just black and white. The government doesn't have any money. It comes from somewhere. They have to get it from someplace. And when they just print money, that's not a good thing either, because that is inflationary. It brings down the value of the dollar, the more money that they're spending. And we've got a number of things that are happening right now. And we'll bring in a little bit into the election piece as well on what that might look like. But just the other day, for example, President Biden relieved another $4.5 billion of student loan debt. So that money is debt that's not going to be paid back, or will be paid back essentially through the government paying for it. But in the end, we're all paying through taxes, or they're printing money, or whatever the situation is. Doesn't matter how that gets paid for, it adds additional cost, which additional cost to us, the consumers and the population, that is inflationary. It makes the cost of everything go up. And again, arch enemy of mortgage bonds, mortgage-backed securities is inflation. So that one thing had an effect. So you add the government spending, relieving $4.5 billion of student loan debt. Those things are concerns. They're inflation, and that's having an effect from the government standpoint on mortgage rates. I'm going to touch on the election right now only because it's only 2 weeks away right now. This is not anything political. I'm going to kind of give you an idea of what we're seeing right now. So both candidates on both sides have their own economic plan, okay? The election does not have any direct, specific one thing that affects mortgage rates that says if Republicans get in, then interest rates are going to get better. If Democrats get in, then interest rates are going to get better. There's nothing historically, there's all of these things that say, okay, well, this is what's going to happen, right? It has to do with their policies and what they are planning on doing or saying they're going to do. Again, not to get political, because we can go on for days and get upset everybody on both sides, of course, of who said they were going to do something and then they actually didn't, right? So it happens in every election cycle. Lots of promises made, lots of promises broken. Doesn't matter what party gets in. However, the policies are the concern. Now, where it's getting interesting to, or going to be interesting to see what happens here is both parties. So, Vice President Kamala Harris gets elected. She's Democrat, and Democrats have their own way of spending money. Then Donald Trump gets elected. Well, Republicans have their own way of spending money as well. It's in different areas of the government budget. It's through tariffs on one, it's through debt relief on another, it's going to be tax cuts on another side. It could be, programs for low-income households that they're going to get some sort of, benefit. So either way you look at it, right now, the policies on both sides are unfortunately inflationary. So there's nothing that says specifically that regardless of one side or the other getting in, after November 5th, going into, of course, when they take office in January, but there's nothing that says that after the election, this is going to happen and interest rates are going to get better, or for that matter, they're going to get worse. Because remember, they've been saying these things and these policies for a while now, right? So, and if you're a trader, you're going to look at these things and you're going to say, well, if I know these things are coming, I should probably get ahead as much as I can. So, there's already been some of that, but then also there's well, how are you going to do these things, right? Is it actually possible to relieve the debt, or is it actually possible to do the tax cuts, or is it actually whatever? Then the trades will happen based on what actually happens as well. So just keep that in mind, that right now there's a lot of concerns when you're talking to your buyers and sellers about this is going to happen after the election. That's not exactly how this thing works, right? So I hope that helps in your conversations there. Last part, of course, is technicals. Now, of course, we have a lot of reports coming out next week, that jobs numbers and PCE and all of that. And then November 5th, we have our election. And then November 7th is the next Fed meeting. There's a lot that's going to happen in the next 2 to 2.5 weeks or so. Okay. So technicals take a back seat to news. They always do. However, technically, not the best picture in the world right now either. We'll have to see what happens actually today, as mortgage bonds have sold off all the way down to their 200-day moving average. It's one of the strongest levels of support when we're coming down to it, and the strongest level of resistance when we're coming and bouncing up against it when things are getting good. So right now, we're sitting on that 200-day moving average. Hopefully, bonds can find a floor here and then start to come back, and interest rates will start to improve from here. However, there's no guarantee in that, and it's all news-based. So if we get a good jobs report next week and we're sitting right on this floor, that could be something that would be a catalyst to have bond traders sell below the 200-day moving average. If the jobs numbers come in way worse, because through some analysis, and there's some speculation, of course, from the last reports, but the last reports basically possibly could be overinflated. So who knows what that's going to end up being when the final corrections come in a couple of months or something. But these reports, when they come out next week, we will need to see essentially a flat to a worse jobs report for interest rates to start to find a floor and get better. We're also going to need to see that inflation reports come in next week in line or better, showing inflation coming down for interest rates to get better. If those two things happen, or one, well, they're going to offset if one or the other doesn't do what it's supposed to do. But if they both come in bond friendly, bad jobs numbers and good inflation, then we will see interest rates get better. If they get worse, they come in higher jobs numbers or higher inflation, then we could see interest rates get a little bit worse from here. And not sure exactly where the next floor and technicals and all of that stuff come in, and we'll have to see where that plays out. But that's what we've got coming next week. This week's kind of quiet, but it's being moved by news with the Fed coming out and saying things. So hope you guys have a great week, a productive week. If there's anything that you need from me or my team, feel free to reach out to us. You can always call or text or email us, and we're happy to help. And we'll talk to you guys again soon.